this is the first AE4RIA seminar. Conrad will introduce what AE4RIA is. We are very happy to have Conrad here. Conrad was born and raised in the Athens University of Economics and Business. So he has done his first MSc and PhD here. And he has developed a line of work in AE4RIA that is actually facilitating the implementation of the ESG framework in companies, but also beyond entrepreneurial units, also within countries, regions, municipalities, universities, in order to produce a tool, first a methodology, and then the transposition of that methodology into a tool that allows the transformation of these units, be it countries or companies or institutions, into ESG, environmental, social, governance criteria consistent, and SDG consistent, that is Sustainable Development Goals consistent. This is a line of work within AE4RIA. Are you going to introduce AE4RIA? You are, right?
Yes.
Okay. That has gained a lot of momentum. That is, we work with many companies, countries, institutions, multilateral organizations that use this methodology and structure. And lately, it has been endorsed by EIB. So I give the floor to Conrad, and I thank you for being here. No, it's okay. I'm gonna see a full time.
Okay, thank you for the introduction, Phoebe. And so, as we said, this paper actually is the Momentum International Stock Returns. It's based on the line of work that we do in AE4RIA and on the tools that we have built for companies in relation to their transformation towards sustainability. Now, a very short, since this is the first seminar of the series, let me make an introduction to our network. So AE4RIA, it's a cluster of universities and research institutions and accelerators. So mainly we have a lab, ReSEES laboratory, the Athens University of Economics and Business, is a sustainable development unit in the ATHENA Research Center, where ATHENA Research Center is the largest research center in Greece. And also we are associated with the Danish Technical University and the sustainability unit in the Department of Technology Management and Economics. Yes, so we also have we run a lot of accelerators as the MENA Maritime Accelerator, Brigade Connect, the Black Sea Accelerator, with more than 1,000 solutions that offer more than 1,000 solutions, more than 500 startups that offer innovations for sustainability, towards sustainability. Okay. Also, we are highly involved with science policy networks as UNSDSN. Professor Phoebe Koundouri is leading UNSDSN Europe and UNSDSN Greece. And we're also highly involved in other networks as Water Europe and the Nexus Cluster, and also scientific associations and academies as ERI, the European Association of Environmental Economists, Academia Europaea, World Academy of Arts and Science. So now our network is large. We have more than 200 researchers internationally with more than 100 projects, mainly big European projects in spanning.
Contracted researchers. This is not the network.
Yeah, yes, contracted researchers. And we, our projects span more than 100 countries. and with having generated more than 500 million of funding. Now, our transdisciplinary research actually has we have 6 pillars in our project. So we have many projects that are related to climate neutrality and resilience. We have also water, energy, food nexus projects, oceans and seas. We have innovation acceleration, as I referred to earlier, education, upskilling and reskilling programs. And also we do a lot of work in SDG and ESG related metrics and corporate sustainability transformation. Okay, now this paper, this academic paper.
But the Black Sea Accelerator, there is not like one responsible or one organization.
What do you mean? It's a collaboration of the two.
It's a
I
project.
think so.
Can you
No, it's an activity and
Can you
there's
move
projects.
from there?
No, I don't think so.
Blue Growth Accelerator, which is a common activity, and the Black Sea Accelerator is what the Doors is doing.
Bridges says the Black Sea Accelerator.
Yeah, because they have messed it up.
Initially,
But it's Blue Growth Accelerator. Or the vice versa. My mistake. Maybe it's my mistake.
Yeah.
It's the vice versa.
Because I think it's advertised everywhere. And
Is the Black Sea Accelerator, let's say the one that they both flew, yeah, Labron.
Okay, now in this paper, we actually explore relationship between ESG and financial performance. Okay, and we're trying to explore if there are sources of price risk in relation to financial risk related to the environment, social and other governance considerations. Okay, and there has been quite extensive literature during the last 10 years on this direction, and there is many papers that have actually positively relate the sustainability performance of companies together with the financial performance, as this can be expressed by the cost of capital, stock valuation, or stock returns, with a series of important papers published in high-ranked journals. Just to mention some examples, Whelan et al. On 2021 providing an extensive meta-analysis covering more than 2,000 papers that focus on ESGs, and actually they find that 26 at least of papers, 26% at least of papers that focus on disclosure alone found a positive correlation between financial performance and disclosure, and more than 53% find a positive performance between several different types of ESG measure and the financial performance of companies as it can be expressed by the cost of capital, stock valuation, or stock returns. In the same direction, Stern has also published a meta-analysis where they present the results from 245 papers from 2016 to 2020, and also there is the majority of papers, 58%, actually present a positive relationship between ESG and financial performance, while only 8% of the papers actually find a negative relation between sustainability and the returns of assets. Okay, so now in general, in the asset pricing literature, so ESG factors have transitioned during the last 15 years from socially responsible investment to a fundamental actual component in financial markets. Definitely in the world, EU It's a front runner in integrating ESGs and sustainability into the European market. So the European Union, through the last 10 years, have gradually introduced a lot of initiatives, a lot of framework, such as the Sustainable Finance Framework, the EU Taxonomy Regulation, or the Corporate Sustainability Reporting Directive. Okay, now the Corporate Sustainability, although during the last 2 months there are, we expect that the Corporate Sustainability Reporting Directive would be a little bit downgraded, and we are waiting for a new directive by the end of the month. Apart from this fact, from 2023, actually, all companies first, the large companies, and then gradually the SMEs, and actually all companies in Europe, except from companies with 15 employees, will have to mandatorily report on their ESGs at the end of the year. And gradually by 2028, the sustainability reports will also be audited by third parties. Okay, so it's Europe, it's a front runner in the integration of ESGs, but it is something that's gradually now very relevant, and all companies are all companies have started to either at least measure or thinking about their sustainability performance. Okay, now the link also between the ESG and financial performance, we have that many papers as Berg, Taramov, and Dorfleiner 2020, where we found a positive relationship between asset returns and ESG performance. And there is also a large literature that focuses actually on the uncertainty that the measurement of the ESG metrics is introducing, okay? So we have many agencies, we have many ratings. The results from using data from different providers at different ratings creates an uncertainty, which is a concern in the underlying literature. So also there is work that on ESG momentum that says that improvement in ESG practice is actually correlated with positive stock returns. And actually our paper will focus more on the ESG momentum. And during the last 3 to 5 years, there is also an increasing interest in ESG metrics to incorporate sustainability development goals to enhance their practical application in financial markets. Okay, and Becker et al. 2023, Navi et al. 2016, it's good examples here. Now, there is also work that has been made on introducing ESGs into pricing models, such as the model of Pastor and Pedersen in 2021 and 2019, where they have demonstrated that ESG factors are also are influencing asset pricing. And actually, Pedersen shows that the stocks with the companies with a bad ESG performance are more risky, and so they have a higher expected returns than stocks with a good ESG performance that have that are less risky, and that is we expect they have a lower expected return. Okay, so there is already evidence that ESG is related to risk, and companies that do not integrate and do not actively manage these risks have higher expected returns to compensate for the higher risk for these companies. Okay, now our study contributes to literature across 4 important directions. Okay, so first we document the strong ESG momentum across all international markets, 69 international markets in the years 2002 to 2023. Sorry. We also introduce ESG risk in the arbitrage pricing theory model to explore for the presence of sources of price risk in the asset of returns. Also, we do define a couple of metrics to measure the greenwashing in international markets, and we also underline that controversies in relation to ESG announcements. So that is greenwashing in the announcements of the ESG performance of the companies is also an important factor that needs to be integrated in the models. Okay, now we also have applications that show that such type of asset pricing models are especially useful for SMEs. So as investors, we really need to use these models, first of all, in order to be able to price assets, SMEs which do not yet and will not up until the end of 2028 report on their sustainability performance. And finally, we do introduce a data-driven approach to make the first steps in integrating the Sustainable Development Goals into our asset pricing framework. Now, our paper is using comprehensive international database with more than 11,400 stocks from 69 markets internationally, which actually
αλλάζει slides, τα οποία δεν βλέπουμε.
Όχι, αλλά ίσως λένε ότι δεν βλέπουν τα slides. Αλλά...
Ακριβώς, καλησπέρα. Έχω στείλει ήδη στο chat. Sorry for interrupting.
Yeah, thank you. Okay, can you see now?
Yes, I can. Thank you.
Okay, thank you. Okay, so as I said, we have a large database of more than 11,000 stocks consisting of 90% of global market capitalization that span 69 countries and 59 industries for more than 20 years. Okay, now just to say a few more about the metrics, we use the Thomson Reuters Refinitiv Aecon scores, the ESG ratings that are offered through Aecon. Okay, now Aecon uses more than 600 KPIs to calculate these factors. So mainly the ratings are using actually 12 material issues. So these material issues refer to emissions. So which means the effectiveness of company to reduce its emissions. Okay, now each one of the material issues uses more than one or more KPIs in order to be measured. Okay, and the Aecon offers 600 individual KPIs so for these scores to be calculated. Okay, now the first important material issue is emissions.
KPIs just for emissions?
No. 600 KPIs in general. From these 600 KPIs, some material issues are calculated, and based on the material issues, these are aggregated into the ESG pillars.
Maybe to explain the material issues.
Yes, material issues are important categories under the three pillars. So, for example, under environment, okay, the Aecon calculates factors for three important, let's say, topics. These are called material issues. The first is emission, which tries to measure the effectiveness of company in reducing its environmental emissions. The second is resource use, which are different KPIs that try to calculate the company's performance and its capacity to reduce the use of material, energy, and water. There is also environmental innovation, which is company's capacity to reduce the environmental costs and burdens by using new technologies and new processes to create new opportunities. It is also going to the social pillar. We do have metrics which measure workforce, and by workforce, we mean companies' effectiveness in terms of providing job satisfaction or a healthy and safe environment for the employees, maintain at the same time diversity and equal opportunities for in the employees. Okay, we have human rights, where we try to measure the respect of fundamental human rights in the company. There is community, try to measure good practices, protecting public health and respecting business ethics. There is also product responsibility, so which measure the quality of goods and services, integrating also the customer's health and safety, integrity, and data privacy. Also management that measures a series of good management practice from the company, shareholders, that different KPIs that trying to measure the effectiveness of company towards the equal treatment of shareholders, and in taking effective towards equal treatment of their stakeholders, and also CSR practices, which are trying to measure how much the sustainability practices are integrated in the daily practice of companies. Okay, so all of these that I refer to are different factors measured through these 12 material issues, which then are aggregated to under the 3 pillars: ES, environment, social, and governance. Now, in most of these metrics, okay, hybrid metrics are used. So, for example, in order to measure water use from a company, this is scaled with revenues or the turnover. So this metric not only actually provides a good indicator, okay, which can be measured on different industries, but is also adjust for differences in firm sizes. Okay, so all of the KPIs used in the calculation of material issues, all of the KPIs used in the calculation of the pillar scores and on the ESG score are actually using hybrid metrics and scaled measures to account for also for differences in size. Now, the second set of scores that we use are ESG controversies, and ESG controversies are actually data-driven scores which are offered and measure a company exposure to environmental, social, and governance controversies and negative events reflected in global media. So there are 24 indicators, closely 2 indicators per material issue, as I reported previously. And the idea here is that we need to have an independent measure because the data reported by the companies are not audited, okay? So in light of greenwashing, and since these data are reported by the companies, but there is no audit in this data, these type of indicators try to measure if there is a controversy between what is reported, what company reports, and evidence that we can find in news. Okay, so just to provide an example, in resource use category and environmental controversies, it can be the number of controversies related to the environmental impact of the company's operations, or natural resources or local communities. Okay, so these are independent scores that we will use later on in order also to measure, to create 1 or 2 metrics of greenwashing. Now, for all of these KPIs and the data for all the company, we do follow the filtering approach of Landis and Skouras 2021. Okay, so the all data from Thomson Reuters Aecon are carefully filtered based on this methodology, where actually in this paper are 21 specific filters which are proposed in order to remove any error and biases in Reuters and Aecon data, so the data to be comparable to CRISP in the USA. So now, after applying these filters, here we have the number of companies used in our sample, and the blue line corresponds to the valid data points for pricing data, that is returns and market capitalizations, while the orange refers to the validity of ESG data, so data that suffice for the calculation of all of these, of all the previous factors. Okay, and you can see that actually in time there's a gradual increase in the number of companies covered or start to report their ESG data. Okay, so the coverage is quite low by the start of the sample. So up until 2007, we have close to only 2,000 companies in all of our international sample, where we end up with more than 10 companies in 2021. Okay, now the difference between the pricing, also it is important to have in mind the blue line, which is for how many stocks we have pricing data. So we have a difference. We will have data for 1/3 of the entire sample, which actually lowers a lot by the end of the sample to having very, very close data for all companies. Okay. Now, the first result, we start with creating univariate sorts, using ESG, simple ESG score as a characteristic. So here, each column of this table calculates 5, 10, 20, 30 portfolios based on the ESG score of companies. And we report here the good minus bad, that is the difference between the return of the portfolio with the highest ESG score and the return of the portfolio with the lowest ESG score. Okay, and we use here a lot of fractals from 5 to 200. So in order to see if there is any effect in the cross-section of the ESG scores. And in line actually with a lot of papers internationally using the entire sample, we do not see much evidence that an ESG score is related to a good or bad performance. So as you can see here, all results are not statistically significant. So we cannot find a statistically significant relationship between the ESG score of the company in the previous year and the return of the company in the following month. Now, same is true if we use the ESG controversies scores. Okay, so we do not see, we cannot find any statistically significant difference between companies with a good or with high or low ESG controversy in their score. Okay, so none of these results are statistically significant. Now, on the other hand, we do find very strong ESG momentum. So by ESG momentum, we mean the growth of the ESG score. Okay, so this metric measures how the ESG score changed during the last 2 years. Okay, so now here we can see the good minus bad portfolio. That is a portfolio with a 10% of stocks with the highest ESG momentum, and the 10%, the difference between the bad portfolio, that is a portfolio with the 10% of stocks with the lowest momentum score. And we can see that this portfolio actually generates a monthly return of 0.73%, with a new USD stat of 2.7 and an annualized Sharpe ratio of 0.5. Okay, now here in this graph, we do simply show the value of $1 invested on 4 different portfolios. The blue is the ESG momentum that invests long in the 10% of stocks with the highest momentum during the last 2 years, and goes short on the stocks with the lowest momentum during the last 2 years. Now, the red line is the market factor. Yes. We show later. It's later.
Okay.
No, this is this single portfolio sorted based on ESG momentum. So the model comes later. It is there. Okay. So now, the same is true if we lower the sample from 2012 to 2022. So here also we see the value of $1 invested to the 10% of stocks with a good performance, with a high ESG score or and the one value invested in a portfolio with ESG losers, that is the 10% of stocks with the lowest ESG momentum. Now, we can see that the differences between these portfolios are really significant. So the momentum winners actually outperform the market by 211 basis points, and this is statistically significant. And also there is a statistical significant difference between winners and losers, or a statistically significant underperformance of losers relative to the market. Okay, so all of these differences are very significant, especially in the last 10 years, in 2012 to 2022. Okay, now let's also see what's happening with what's going on with ESG controversies. So again, if we calculate a momentum of ESG controversies, so what does this mean? Stocks that tend to ameliorate their performance in relation to controversies. So stocks that have less controversies that they had during the previous 2 years. Okay, so this means stocks with a high growth on a score against controversy tend also to exhibit very high returns during the next period. So we can see here also that the value a portfolio with $1 invested at the start of the sample up until 2022 in such a decile strategy between good and bad performance in relation to ESG controversy momentum. So now this strategy generates 0.26% with an annualized Sharpe ratio of 0.55. So we can see that there is a strong, so in the two previous examples, we can see that there is a strong ESG momentum and also ESG controversy effect, okay? So now we are trying to incorporate these effects into an asset pricing setup. So we extend the Pharma Friends three-factor model to calculate factors that are related to ESGs. Okay, now, of course, for these factors, we do follow the common Pharma Friends methodology of how to calculate such type of factor mimicking portfolio. Okay, so these are a well-diversified portfolio from the intersection of different portfolios between ESG, momentum, and size. Okay, and we do follow the conventions since we are using international data. We do follow the Pharma Friends conventions for the calculation of factors for their international factors, that is the developed and developed ex-USA factors. Okay, now also we do try to combine the two effects and calculate a aggregate score that actually sums both the ESG momentum and the ESG controversies momentum scores. Okay, now just see that this is the value of $1 invested in a factor mimicking portfolio that tries to capture the ESG momentum and ESG control. Here, ESG momentum, the ESG momentum factor. Now, in order to test this asset pricing model, we do generate 20 portfolios double sorted based on ESG momentum and size. Okay, and then we try to see if this model can predict the returns better than the three-factor model. Okay, so now here in these results, we can see that the alpha of these 20 double sorted portfolio lowers when we use the ESG factor model. And also, these are running a GRS test, okay, to test if jointly all alphas are equal to 0. We can see that the power of the test is greater for a model that contains an ESG factor against the three-factor model. Okay, now in order to explore if this return persists in time, here we actually calculate we perform Fama-Macbeth regressions with future returns or on ESG momentum scores. Okay, and we can see that as the period increases, so as we keep stocks from month T to month T plus 12, so these return premiums seem to persist. Okay, so we can see here that these pharma betas are highly statistically significant, and they continue to increase up until 12 months after the portfolio formation. So this result is also in line with Henrik's et al. 2018, which actually shows that the ESG score is related to the long-term performance of the companies, not the ESG momentum, but the ESG score, okay? So Henrikson says that companies that do perform good on ESGs for a long period tend to have high long-term returns, okay? So now our model, as I said, it's also useful in order to be able to price SMEs. So in this exercise here, we do the following. We are using our ESG factors, ESG momentum factors in order to price assets for which we do not have sustainability performance. So assets for which sustainability data are not available, okay? So in this sample, in the first panel, we do have 5,342 stocks. We regress these stocks based on the ESG factor model. And then here we group two types of stocks. The assets that have a high and significant beta with an ESG factor, and the assets that have a negative and significant beta loading on our ESG momentum factor. Okay, and then we calculate the mean return over the next year for the companies that have a positive and significant loading to the ESG momentum factor, and the companies that have a significant negative loading to the ESG factor. So we can clearly see that the companies that have a significant negative loading tend to also have a very, very negative return during the next year. Okay, and on the other hand, we can see that the stocks that have high and significant loadings to the ESG factor, ESG momentum factor, also tend to have a very, very high return and significant return during the next year. Okay, so in this sense, we can use this model in order to identify stocks for which we do not have ratings, and we are able to price these stocks and let's say understand if they are stocks that are ameliorating their ESG performance or stocks that are deteriorating their ESG performance. Now, before I close, I will also refer to some calculations for the level of greenwashing. Okay, so using the previous scores, the difference between the two scores can be used in order to get an estimate of the greenwashing in the different markets. And here we do calculate the average difference on different sectors. And this is plotted here. And we can see that we can calculate very significant greenwashing in financial sector, and these differences are statistically significant, and also in the utilities sector. Now, please note that in time, these differences seem to getting smaller, okay? And the idea of these results here is that we expect that these differences will completely disappear, for example, at least to Europe, after the final step of the corporate sustainability reporting, where the data of the companies will be audited, okay? So we expect that this relatively high greenwashing that existed during the last 10 years will tend to disappear, at least to Europe, when the framework will oblige companies to audit their reports, okay? And here also I add an interesting result for the shipping sector, and also internationally using the only the companies in shipping, okay? We also have a very high ESG momentum. And in general, okay, I do not show here results for different countries or different sectors, but the results are robust. So with very little details in relation to breakpoints, etc., the ESG momentum is really strong on all markets internationally and in all sectors. But the specific of interest here is that the shipping sector tend to have a really high greenwashing, okay, close to 5% during the entire sample. So the reason I show here is that it is the sector with the highest greenwashing in our sample. Okay, now very, very quickly, in order to close the presentation, I will also say a few words about integrating the Sustainable Development Goals in the current framework. Okay, so now what we do here is using machine learning and deep learning techniques, we actually map the ESG KPIs, the material issues and the KPIs that I referred to previously to the SDGs indicators. Okay, so having a metric like that, it gives us then the opportunity to calculate very broadly how much each one of the KPIs is related to each one of the SDGs. Okay, and then we use this framework in order to introduce factors in relation to SDGs. So this is work in progress, but I just show you here how these SDG factor mimicking portfolios look like. Okay, and using these type of models, we are able actually to calculate not only ESGs, but the SDG footprint of different financial portfolios, okay? So this model could be used in order to be able to calculate the sensitivity, for example, of a financial portfolio to these factors. But this is still work in progress. So thank you, and I will leave 10 minutes for questions also.
Do you have any questions?
I wanted to ask about the result of analysis now in the face of Trump policy and against GDI, against climate change research, and whether it can you speculate whether the trends that you observed in the historical data will continue from 2025 to 2029?
I think they definitely will. Okay, there are some effects that, okay, so for some effects, for some asset pricing effects that measure the overreaction maybe of investors in relation to ESG data, then yes, I expect that these effects will tend to be a lot more weak during the next years. But at least up until now, there is a lot of research that shows that the ESGs are a lot more than, at the level that they are discussed right now. Okay, so there are many benefits, there are risks and opportunities from actively managing let's say, all of these material issues that I gave space and explained in the start. Okay, so definitely these risks are related to opportunities for the company, and so I do not expect that this premium will disappear.
Can you explain more explicitly how the suggested transformation of the value chain can be derived from this ESG tool? Because I think this is the value added in addition, of course, to showcasing that is profitable to drive those portfolio or investment. How you would react if you were an entrepreneur and you had an ESG legislation to be implemented? How would you use this tool in order to transform the business plan and manage or at least capitalize on the opportunities that ESG is bringing throughout the value chain?
Well, these models not exactly, so, but they are related. So for a company actually what has to do is try to first identify, okay, perform a very good materiality assessment to identify which are the material factors that do affect its performance and that they are connected with specific risks. And then should be able to measure with KPIs such as the ones for stocks that we have used here, need to measure its performance across all of these material issues, across all the pillars, in across all levels of its value chain, okay? And then set specific targets for implementation for these KPIs. Now, this is the same logic for a company. Here, actually, these models can be used, though, to calculate the sensitivity of a financial portfolio or
Yes, but wouldn't you need to solve the two, or at least consider the two, the value chain of the actual production line, say, and distribution, together with the portfolio management, because big companies that are now obliged to submit the corporate sustainability report have an asset management part, and they also have a production part. So wouldn't you see synergies and trade-offs in the management of the two with regards to how they function for the whole company? I mean, imagine they, for example,
yes, of
in a
course.
big company.
Of course.
So can we bring the two together? What we do for the two for the value chain and the two for the portfolios, the asset management?
Of course. Of course, they can bring together. Now, in order, let's say I transpose this question, but in order we incorporate the metrics in such type of analysis, then I don't think there are data for that many companies across the value chain that someone could use to integrate that into these models. But yes, definitely these models can.
For the companies that we work for, they give us the data for the value chain, and then we incorporate this analysis of portfolios into their business.
Yes.
Any other question?
I think maybe just building on what Ruslana was asking earlier, so given the whole Trump effect and looking at the kind of change in temperature for the global climate around ESG, sustainability related initiatives, how do you find it then engaging the business sector and the organizations, corporations, since these would be the main target audience for such a tool?
I'm not sure I understood completely the question.
How has the whole sort of change in climate affected the engagement, or have you noticed any change in the engagement with corporations since they are the main targets for this type of tool?
No, I don't think they're really affected, and the reason is that there is very skepticism, but for many material issues across everything that we discuss. So there is very skepticism, for example, from companies on the need and the investment that is needed to lower their emissions. Okay, now as we see previously, emissions is the 1/20th of this analysis. Okay, so companies do see very clear nowadays that there is a huge benefit from actively manage most of the risks related to ESGs.
So they are affected. So they are.
I thought they are affected by Trump. No.
Sorry.
Yeah, no, I was asking if they're affected by the Trump effect, and are you seeing?
But Trump
No, not really, not really.
Weeks, how would it
Not really. Though right now the discussion is that in the EU maybe the framework needs to be relaxed. Okay, so for example, they are thinking that the framework needs to be less restrictive for the companies. Okay, just in fear of lowering their, I don't know, the relation with the other regions of the world, okay? But I don't see it has a huge impact, at least with what we discussed. Maybe it has in relation to, I think it's only in relation to emissions, the skepticism, okay? So yes, maybe there will be a little bit burdens towards decarbonization, but in general, in the ESGs and the active management of all of these risks, I don't think so.
Yeah, but yes.
Well, I'll change the topic. I don't know if you want to follow up though. So I was wondering, I didn't get exactly, how did you transform the data that you scraped for the controversies? So you did some text analytics from news items and then you transform them into
No, the first controversies are offered by ACON.
Oh, they're offered by
Yes, so ACON reports that for this company we have counted that many controversies for this aspect. So the raw data for everything, it comes from ACON.
But we have some social media information integrated.
Yes, not in this result for 11,000 comments. So we are working on that. So in general, there is one of our research topics is to calculate such type and a lot more controversies through data feeds for, let's say, for a company that we work together, but not now we don't have, let's say, a database that extent database of controversies that we had calculated from directly from the news.
I just wanted to say that with the Trump thing, I mean, Europe is trying now to sort out its legal structure to help the companies, the European framework, which is embedded in the European GDPR. It's really messy. It's really difficult to navigate through. We are looking at 150 exclusive regulations that have been transposed into national regulations, and it's a mess. They are overlapping, they are canceling each other out. So it's very difficult for European companies to actually implement on the different material issues that they have to incorporate corporate sustainability report. So this has to go, and its ability to regulate itself, and it's in a way independent from all that is happening in the geopolitical space. So sometimes you read, newspaper articles, meaning in serious, mass media communication outlets like the Financial Times and the Economist and blah, 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 very soft but serious they are considered. And they say, we are relaxing ESG framework. We are not doing that. We are trying to sort out
and streamline
it because it's truly, truly messy for political analysis, let alone the context. Now, with Trump, I think Trump will be focusing on anything that has a business case. So if it's cheaper to go along the ESGs, then they will go along the ESGs. It is important that Asia is adopting ESGs, and important countries in Asia, like India, they are really quite advanced in this thing. China is also on board. China is one of the countries that are now 2060 neutrality, and they are expected to achieve neutrality before 2050, that is before Europe. So what is actually happening on the ground is leaving Europe behind. Just because Europe has a very complicated structure of striking an agreement between 37 countries, whereas other locations are more immediate, like China. We're not saying we want this kind of regime, but it's more immediate. And I think a year after Trump, we will have enough data just to see how the trend will diverge. There is a lot of investment of fossil in his voters, but there is also huge investments in anything that is electric and non-fossil derived electricity. So it is very, very difficult to forecast that the trend will change, especially because technology is down the green and digital agenda, and it's getting cheaper and cheaper and cheaper. So it's about, yes, unfortunately, public plus private decisions to invest on the infrastructure that is going to support this green and digital. Because now we have the technology which is cheaper per unit than the fossil and the non-digital, but what is missing is the infrastructure. So creating the infrastructure is China is easy. China has invested around the world in this infrastructure, from Latin America to Africa, that you know very well, to other places. And Europe is also lagging behind seriously in infrastructure that has the capacity to go to climate neutrality. So the work we do on the Global Climate Hub with Angelos and Alamanos and Yannis and Stasis showcases that the efficiency with which we are reaching the targets that are identified in the climate and energy plans of each and every country in EU 27, it's lacking in pace because of missing infrastructure and started legislation and inability to actually impose something that is coherent in terms of the transposition of the legislation into an actual implementation in terms of public infrastructure and capacity to have the labor force to engage in these new technologies. So the big two problems in Euros is public infrastructure and skills, rather than the cost of the per unit transition. The cost of the presidency transition is lower to go green and digital. So it's not a straightforward answer question.
Yeah, I agree. So, because there's that kind of this disconnect as well, like you said, between the rhetoric on one level, but also operationally what's actually happening in the market. And so I think this type of tool is actually very timely in this particular era, because you can clearly demonstrate scientifically the performance of these green portfolios against the portfolios that are not so green. So there's a clear business case to be made there.
Yeah. And it's not just the portfolios, it's also the actual value chain, the cost of the actual production line and distribution and logistics. If you look at the whole value chain, starting from where the inputs are coming from, raw materials, to how they are recycled and disposed and waste is disposed. And sorry, are there any other questions? So thank you guys, we are 4 minutes.
Thank you so much.
There is Dr. Feretzakis, who will be speaking about machine learning and skills, trying to identify what skills we need for the green and digital transition and how we can upskill and reskill even existing curriculum. Okay, thank you very much.
Thank you.
Really got this.